Okay, let's jump right in. The market is flashing some major warning signs right now. We're talking about gold blowing past a critical level and oil just refusing to come down. Let's get straight to the numbers.
First up, look at this. Gold has absolutely smashed its all-time high. We just saw it hit $4,888.
And it's not just gold. At the exact same time, you've got WTI crude oil, and it's just stubbornly sitting above $100 a barrel.
So you put those two things together, and what do you get? It means the Fed is officially completely cornered, and we've got the data to prove it.
All right, so here's the deal. The Fed is caught in a perfect storm, right? You've got the sticky inflation on one side and global chaos on the other. And the real problem? Their old playbook, all the tools they usually use to fix things, well, they're just not working anymore.
Okay, let's look at what the Fed itself is saying. This is their dot plot for March 2026. Think of it like a survey of where all the top Fed officials think rates are headed. And wow, the message could not be clearer. Just look at those top two rows. You've got 14 out of 19 members, that's the vast majority, seeing either just one rate cut or, get this, no cuts at all by the end of 2026. That is about as hawkish as it gets, folks. They are planning to keep money tight.
And here's exactly why their hands are tied. They're actually revising their own forecasts up. They're expecting a higher inflation and stronger growth than they did before. So while everyone in the market is crossing their fingers for rate cuts, the Fed is looking at its own data, which is screaming, hey, inflation is sticky and the economy is holding up. That tells them one thing: they have to keep rates high. Okay, so that's the domestic picture. Now let's talk about let's call it the global pressure cooker, because this is a huge shift in thinking. Geopolitical risk, it's not just a temporary headache anymore. It's a permanent, baked-in feature of the market now. And we're not talking about one little fire to put out. No way. Investors are looking at a world map that's just lit up with hotspots. You've got the ongoing US-China tensions, you've got Russia making moves in Europe, you have a hot war kicking off again in the Middle East. And on top of all that, there's this mad dash for strategic resources like rare earths. It's coming from all sides. And if you want to put a number on that risk, just think about the Strait of Hormuz. One little stretch of water, 20%. 20% of the entire world's daily oil and natural gas flows right through there. So yeah, when things get tense in that spot, believe me, the whole global economy holds its breath.
You know, this really brings us to the new reality. And Dun & Bradstreet, I think, said it perfectly in their latest outlook. They said, businesses can no longer treat geopolitics as background noise. And that's it, right there. It's not noise anymore. It's the main event. It's front and center for any serious investor.
All right, before we dive into what this all means, just the standard but very important disclaimer: this is for educational and informational purposes only. This is not and should not be taken as financial advice for your specific situation. Okay, now this is where things get really, really interesting. So you've got the Fed in a corner. You've got the world on fire. You'd think you know how this story goes, right? You'd expect the classic safe havens to act in a certain way. Well, they're not. The old rulebook is being thrown out the window. And that brings us to the central mystery we need to solve here. If this crisis premium, that extra price people pay for safety, is now a permanent thing, then why on earth is gold, the classic safe haven, suddenly going completely off script? Let's look at the hard data. I mean, historically, in a world like this, gold should be soaring. But look what happened in March 2026. With all this tension ratcheting up, gold didn't rally. It dropped a shocking 12%. That's its worst month in more than a decade. It makes no sense. Or does it? Okay, so this chart helps us unravel the mystery. A strong dollar pushing gold down? Yep, that's normal. Check. But everything else is getting turned on its head. That crisis premium we talked about, it's being totally wiped out by something called liquidity stress. Basically, people are so desperate for cash, they're forced to sell everything, even their safe stuff like gold. And what about hopes for rate cuts? Gone. Neutralized. Because high oil prices are making everyone freak out about inflation again, which forces the Fed's hand to stay tough. And this is the key takeaway. We are in a totally new market dynamic. The old if this, then that rules just don't apply anymore. This is exactly the kind of shift we track here. So if you want to stay ahead of the curve, now is the time to subscribe. So the big question is, what on earth are you supposed to do with your portfolio in a world like this? All right, let's get to it. This is the 2026 action plan. We're going to lay out a framework to build a resilient portfolio for this incredibly complicated environment. But first, let's get our mindset right.
And I love this quote from Stifel because it nails it. This isn't about trying to time the market or make a quick trade. It's about a real long-term strategy. They say a well-constructed, goals-aligned allocation remains the most effective way to endure volatility while staying positioned for opportunity. That's the game plan.
So we've boiled down the guidance from a bunch of different sources, and here's the consensus action plan. First, overweight U.S. stocks because AI is expected to really drive productivity and earnings. Second, also overweight equities in Asia, but excluding Japan. The fundamentals there just look really solid. Now here's the interesting one. Despite that paradox we talked about, the call is to still be overweight gold. But think of it differently. It's not for a short-term pop. It's a long-term strategic piece of your portfolio, especially with central banks buying it up like crazy. And finally, for fixed income, the play is to be neutral, but focus on super high-quality bonds to help you ride out the bumps.
Look, in an environment this complex, just understanding the moving parts is half the battle, and taking action is critical. If you really want to get the full picture on how all these forces are colliding, you need to binge watch our entire geopolitical macro analysis playlist. We've linked it right here for you.